Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Sallie Krawcheck, co-founder and CEO of Ellevest, an investment platform for women she founded, in 2016?
2016.
Nice to see you, Sallie, by the way.
Good to see you, too.
So, a lot to talk about. I want to ask you about Ellevest, of course, and how's it going. But let's start off with, of course, the banking sector. You know a little bit about
Why?
that,
Is
right?
something going on?
You worked
Andy?
at Sanford Bernstein, you worked at Citigroup, you worked at Merrill Lynch, ran those businesses. So, big view, what is your take on this banking crisis, some people have called it, problems that we're having in the banking sector?
Well, I think if you step back to first principles, banks make their money by taking risk, and they are bundles of risk. They are interest rate risk, they are currency risk, they are consumer credit risk, they're housing risk, they're equity risk, they're FX risk, they're basis risk, they're operational risk. I could go on and on, I often do, but they really are bundles of risk. And then they're leveraged. They have financial risk, and in order to make their money, they leverage their balance sheets. And so they take in deposits, right? They, with them, make loans or invest in securities, and the assets that they buy go up and down. And the liabilities, I don't know about you, but don't you like to get 100 cents back on your dollar of your deposit? You do. And so you have fluctuations that can occur on one side of the balance sheet, not on the other, and you have leverage. And while these banks are less leveraged than they were in the 07-08 crisis by a lot, they're still leveraged. And I like to say you can drown in the ocean and you can drown in a pond. And if you have equity to assets of 7.5% or 8.5%, you don't have to really have much of a loss on the asset side of your balance sheet before you've got to run on the bank.
So there's a lot of smart people working in that sector. That seems to make a lot of sense. Doesn't seem that complicated. How come they screw it up?
Well, so, they don't mean to, of course, and you put things on and you hedge one side versus the other, you position the balance sheet, but people can get things wrong. And when the environment is shifting quickly, as it has, with really an unprecedented increase in interest rates, if you're making a bet with your balance sheet and you make it the wrong way, it can go bad pretty quickly. Of course, what we're experiencing now that we didn't experience in 07, 08, or some of the bank runs before, is technology. We were joking before, back in the day, you had to go to the bank and knock on the window, and I'd like to get my money back, please. And today, it can be in your PJs at night because you decide to. And so all of those factors came together for what was and some others, for a really fast run on Silicon Valley Bank.
Right, and Signature Bank and Silvergate and Credit Suisse. I wonder, so are they really all connected by rising rates?
They are interconnected in so many ways. The other lesson, again, we learn is if you remember back to the subprime crisis, the subprime issue is contained, right? Remember when if Greece has a problem, it is contained. In financial services, in big banking, they're so interconnected that very little is contained. As an investor, it's very difficult to tell where the interconnectivity is. You get sort of a balance sheet that you look at, but digging in 6 levels is pretty much impossible.
And you talked about consumers being able to get their money out just by going online. Another facet on the consumer side, of course, is people communicating on Twitter, on Reddit about problems. And that's sort of a new element as well, right?
Well, it is a new element. And for Silicon Valley Bank, the real issue, or another real issue, is they were so concentrated in the venture world, in the startup world. And that becomes a pretty small community when you're connected on social. And so when the call for the run on the bank occurred, my portfolio company should get out of there, it wasn't some stranger you'd never heard of before, writing a letter by carrier pigeon to people to tell them to take their money out. It was someone everybody knew with a high level of prominence in the industry who was able to do it over social media, so it went like wildfire.
You wrote recently on your website on March 13th about Silicon Valley Bank. In this case, the victim will likely be easy venture money for scooter, meal delivery, crypto, and neobank companies. And it may also mean less truly transformational innovation is funded, the impact of which is incalculable. Can you talk more about incalculable?
Well, the venture money has been tightening up for some period of time. And with Silicon Valley Bank, which I don't know if it was more impactful, to venture and to startups than JP Morgan, the bank, and the person were for, say, railroads. But rarely has there been a financial institution so tightly connected with its customer base and so really concentrated in the customer base. And speaking from experience, the types of venture loans that Silicon Valley Bank was making were not available at the big banks or the medium-sized banks. And so they had found themselves an opportunity. We can debate about the wiseness of taking advantage of it. Maybe they could have done it differently. But they found themselves an opportunity that no one else had. I don't know that Citizens Bank is going to see the opportunity the same way. And thus, what company doesn't get founded? Hopefully it's the ones at the margin. It's the scooter companies that we don't need. We'll never know.
Yeah, Citizens seems to be making a nice living going after banks that kind of have trouble, right? Mm-hmm. You said something that caught my attention before the camera started rolling, and that is, I'm getting sick of these bank runs. So I mean, who isn't? But the question, Sallie, then is, they're animal spirits, mm-hmm. human nature. Is there really anything that we can do? I mean, maybe all regulation is futile.
Well, we can also look at how the bankers are compensated. Back after the 07-08 crisis, I wrote at the time in Harvard Business Review that, we have these bundles of risk, they are leveraged, and then we pay the executives in equity. What is equity? I mean, it's many things. One thing that it is a risk-encouraging instrument. That if you're getting paid in equity, you typically want to take more risk in order to get the equity to go up, right? And generally that's the right bet because the economy grows, credit grows, companies get started. That is typically the right thing to do until it's not. And until you hit some, big downturn like what we've seen. What if instead we said these are forms of utility? What if we paid some portion of the compensation, all of it, some part of it, in bonds, right? And then what is your stance when you're getting paid in a bond? That stance is, let me not take as much risk because all I'm getting is 100 cents on the dollar, and so I want to protect that as opposed to get the downside. And so you could fundamentally shift how the compensation and potentially fundamentally, therefore, shift the risk-taking of the entity.
And the counter argument will be, oh, we won't be able to grow, we won't take risks, we won't be able to compete on the global stage and all those kinds of things. But maybe it's worth the trade-off.
Well, we could try something different. We tried this for a bit, and it's been a long time since I used to be a research analyst covering the banking industry, particularly the big banks, and I have not updated the analysis because I'm busy with my startup and building a business and trying to change women and their families' lives and all that stuff that goes with it. But there was a point at which I looked and said these banks had actually not earned their cost of capital through a cycle in as far back as I could go. And so I'm not saying you have to go the whole way there, but is there some means of moderating the animal spirits?
And we'll get to Ellevest in a minute, I promise.
Okay.
But just a little bit more here. So are we even getting better at regulating banks? I mean, you mentioned they're less levered, right? So are we? I mean, because there's a lot of Sturm und Drang here. We have Dodd-Frank, and then we roll Dodd-Frank back a little bit. And I just wonder, is any of this even really worth it?
Okay, so how is this run on the banks going to play out? Because I think we need that information before we know. If it stops here, and you say, okay, it was Silicon Valley Bank, and that's going to hurt venture and startups, but okay, there you go, and it's Credit Suisse, and that was years in coming. I mean, that was what a drama, what a long time. Okay, fine, we've cleaned it up, and that's it. Then that is one set of circumstances. If, on the other hand, this was our Bear Stearns, and we've still got our Lehman, then it could be an answer to a different question, or a different answer to the same question, whatever. The one thing I will say, and it's really worth underscoring, is the regulators are experienced and they're acting fast and they're acting decisively. And I don't know if you remember, but back in 07, 08, when we were looking into this abyss, and you know, I don't think there have been nothing in business has been as scary as that to me, having a front row seat, being at one of the big banks. But the regulators move slowly. This time, and we saw it also during the pandemic, when the markets were shaky, they moved quickly and decisively, and that's a real step up.
Well, and then some people said that the government moved too decisively and put too much liquidity into the system.
It's so easy being a critic, isn't it?
Right.
I tell
or being
you,
a journalist.
every Monday morning, I sit in my house and
Right.
I critique the NCAA basketball coaches and all their choices, right? And I always can see what they should have done.
All right. Is that your answer about Jay Powell, what Jay Powell has done? I mean, you're cool with it?
I am totally cool with it, and I think the story is still being written.
Fair enough. All right, so let's finally get to Ellevest.
Thank you.
For people who don't know what the company is, maybe you can talk about it a little bit. Broad brush.
So Ellevest's mission is to get more money in the hands of women, with the point of view that we don't know of anything bad that happens when women have more money. Ellevest is an investing platform that helps women and our allies invest from their first dollar through to multiple millions of dollars. It is the only one that was funded by, founded by, built for, investing in and investing through women. With the point of view that women have lost ground on wealth versus men, and some chunk of that is because we haven't invested as much as men do. And so Ellevest was really the first where we said maybe it's not their fault, maybe in an industry which is mostly men, and by mostly, I mean 98% of mutual fund dollars are managed by men. That's what I mean by mostly.
Still.
Indeed, still. 86, 87% of financial advisors are men. Men are fantastic. We wanted to be the company that was really built around women, with the point of view that if it's built by women with experience in the industry, that we could build something that will help women find their way to investing.
And isn't it also the case that women have different needs when it comes to investing?
Well, we have different characteristics that have to inform our investing. Sadly, we earn less over the course of our careers. We take more career breaks. Sadly, our salaries peak sooner, and we live longer. And so if you're giving the same advice to a man and a woman, you may not, she could run out of money. Now, women's needs, to have more money, right? I mean, think about today, all the bad jobs women are stuck in because they don't have the money to leave, or the bad relationships they're stuck in because they don't have the money to leave, or the companies they haven't started because they don't have the money to leave. And so culturally, women aren't supposed to say, I want more money, but we want women to have more money.
Nothing wrong with that.
And when you step back, there have only been a couple of ways in this country to reliably, over a 10 or 15 or 20-year period, and scalably grow wealth. One has been real estate, which takes a down payment, and you got to take on leverage in a mortgage, and certain groups in this country have been redlined out of buying homes. So there's been buying a home, and the real estate prices have gone up on average about 3% a year, or there's investing, where the stock market have gone up 9-10% a year since the early 1900s. You don't have to take out a loan. You don't have to have a big down payment. And so investing can be so much more accessible as a means of building wealth.
How far out can you push the model in terms of, say, women who are starting businesses? Are you serving the business?
Sure.
Also, a woman who wants to bring in family planning. I want to bring my husband in and my kids. All that stuff?
Well, it's interesting because we started as a digital advisor, and then we found exactly that. I'm getting married. I need to put together a budget. I just got a huge promotion. Can I have a certified financial planner? Can I have a financial advisor? And so we are now able to wrap around her with her financial planning as well as her investing. What has really been interesting to me to watch, and where we've had a lot of fun, is women are also increasingly demanding investing for impact. I know there's been pushback. We can politicize anything in this country, but women seem to intuitively recognize that their money is power and their money is impact. And every dollar they invest has an impact, even if they don't know it. Every dollar they invest is gender lens investing. Today it's mostly in men. And so what she has said to us is, I don't want to give up on the financial return, but I want my money to go to places that resonate with me if we're able to. And so we've done that with ETFs in our digital offering. So fun, so interesting is that for our high net worth clients, we've been women investing in women, getting venture dollars to women startup CEOs, investing in workforce housing fixed up in a sustainable way, rented to women in transition, femtech, health tech for women, and investing the money in privates and having a demonstrable positive impact on other women's lives. While most of the industry over the past couple of years, when they were building out, let's go to crypto, at Ellevest we said, let's quadruple down our investment thesis that investing in women leads to positive things, and invest real money in real women.
Although some people suggest that diversity, DEI, ESG is what got Silicon Valley Bank in trouble.
That's a load of bull. Bleep.
You wrote about that recently, right?
Well, it's ridiculous. It's ridiculous. Every bit of research out there says the diversity leads to higher returns through a cycle, lower risk, and greater innovation. And so what I've written about is that if anything, Silicon Valley was not diversified enough in that they, were doing business with mostly venture capitalists and startup folks. That was one of the things that led to the downturn. They weren't diversified enough or have enough diversity, not the opposite.
How do you measure success at Ellevest, Sallie, and how's the business doing?
Well, we hit record assets under management last year, and we had net inflows in our digital business, $1.6 billion. We had net inflows every week when the industry had significant net outflows. So we've got plenty of room to grow for sure. But what really is great is that we are changing women's lives. I go through airports today now that we can fly again, and I'll have my Ellevest bag, and women will stop me. And what's underlying it is money is women's number one source of stress. And when she takes action, when she invests, when she begins to build wealth, it's the number one driver of her confidence in her future. So there are very few offerings out there that can take such a big issue in her life and actually put her on the road to real confidence.
You have a lot of experience, obviously, overseeing these types of businesses and as well as investing yourself. Mm-hmm. I read about this story where you lost 80% of your net worth.
Yes.
What happened there? Tell us about that.
Yeah, that was a long afternoon.
Yeah. What happened? How did you lose 80% of your net worth?
Well, I worked at Citigroup. And at Citigroup, running Smith Barney, running the Citi Private Bank, part of the leadership team, we had sort of a spoken, unspoken, you're on the leadership team, you get granted equity and you hold on to it. Not everybody did. Sandy Weil managed to get the board's approval to sell out, good old Sandy, at pretty much the peak. But as a leader at the company, I held on to the equity, which is, by the way, the exact opposite, obviously, of what we recommend at Ellevest to our clients who are granted equity. The financial crisis hit, and the stock went from, I think, 55, through the 40s, through the 30s, through the 20s, through the 10s, through the O's, and at one point, as you recall, was trading at less than 1. And I think now while it's in the 50s, it's a 10-for-1 reverse split, so it's in the 5s.
Reverse split.
Yeah.
Right. Wow, that's something to recover from. That's a lesson learned the hard way.
Well, I tend to learn all my lessons the hard way. I don't really know why. I can't just read about them, but, oh well.
The number of women CEOs in the S&P 500 has doubled.
Yes.
So we're done here, right? All good?
Well, yes. So if you look back at the past 10 years, and I've sort of, been assessing, Lean In came out 10 years ago, where are we? That has doubled, so it's above 10%.
Oh, so it's doubled from 5 to 10.
5 to 10, right? Okay.
Yeah.
However, the gender pay gap over that period of time has not moved. The gender wealth gap over that period of time has gone backwards. The share that women get of venture dollars has gone down. What has worked is investing. Oh, by the way, I forgot one other thing. You might have noticed last year that women's reproductive rights were attacked and Roe v. Wade was struck down. And so for most women, having more women CEOs, yay. You know, these are things that are affecting particularly young women, and young women see this as affecting them financially and economically.
I want to be clear, by the way, when I was saying we're done here, I was being somewhat
Of course
facetious.
I know that. I know
Okay,
that.
I wanted to be clear.
I know.
Is the
Well,
right
I do get that question. I
Yes,
was
right.
on a TV show the other week, and they're like, you know, and they started giving some examples, like Jane Fraser at Citigroup, and the head of the NYC. I'm like, yeah, except bodily autonomy, folks.
There is that. I want to ask you finally, Sallie, about raising money for Ellevest,
Yeah.
and that you were able to get the first round. It was a little more difficult the second round. There's a Series B cliff.
Yes.
If we can end on the Series B cliff.
Well, that's depressing too, because the great news, you know, that we're seeing in the startup world is there are so many dynamic, intelligent, driven women who are coming in and investing in early stage women-run startups. So they're starting, you know, women are coming together, they're moving out of corporate America or off of Wall Street, and they're forming funds, they're doing it as angel groups. And I probably, not a week goes by that I don't hear from some of these women, you know, we're starting, and we have some of them on our platform. The problem is there are very few women venture capitalists who are writing big growth checks. And in fintech, there are almost none. It's like, you know, you and I could maybe name a few, but there are very few out there. The depressing part of this is that women who raise money from women early stage are less likely to get the Series B done. That there's a Series B cliff. And I think we all sort of assumed, hey, if you can get the women funded at an early stage, the research shows us, it's clear, they tend to grow revenue faster than, you know, all male teams. They tend to get to profitability faster, et cetera. So this shall take care of itself. And it is not. It is not.
Is there something you're optimistic about at this point?
Well, lots of things. Ellevest is one of them, but I tell you what we did with our Series B, because I am not the typical, you know, entrepreneur who walks into a big VC and they're like, oh my gosh, look, it's the woman who ran Merrill Lynch, just who we were hoping for, right? So I can get the meeting, but I don't often look like what a venture capitalist in their pattern recognition is looking for. What we did, which we really stumbled on, was we tapped into our network of women. And at one point when we were raising our Series B, a woman who makes small investments came to me and said, I'm obsessed with Ellevest, gone through the numbers, love the numbers, I want to invest, my check is this big. What if I pull together other angel investors who are women, and we form a special purpose vehicle and we invest as one in Ellevest? And then someone in that special purpose, well, what if we do that? Well, I know some folks, why don't we do that? We raised $53 million doing it. You know, women today raise, women CEOs, 1 in 10,000 Series B fintech dollars. And we overcame that with good numbers, good results, but going back to sort of first principles, how do we tap into women? And I think as we increasingly see that women supporting women, you know, investing in women, promoting women, putting each other on the boards, just as you gentlemen have done, you know, for time immemorial, that is a path forward for us that I feel not only optimistic about, but ravingly optimistic about.
All right. Sallie Krawcheck, co-founder and CEO of Ellevest. Thank you so much for joining us.
Thanks for having me.